हेलो। हाँ। હા, એ તો એપ પરથી જ થયું. 6 people have entered the waiting room. Name આવે છે. So now if I want to join Kaiwan and why is your phone getting disconnected? Um, So if I want to join Kaiwan and Priya, send you. Are you coming? नहीं, I can add you ने link में तू आवશે तो. So this recording is also on.
First of a series of webinar lectures which we are conducting, the Law Society is conducting. This is specifically for the benefit of article clerks who are either ready to give their exams. Hopefully, we will have an exam in October, November. So that seems to be a distinct possibility as of now. But we'll have to look at it as we go ahead, how things are. Things are very fluid, as you know. Things are not certain. But we'll take it on. It doesn't hurt to study. So, you can keep your heads in your books, certainly for the October and November exam. This, as you probably have attended earlier webinar series, which the Law Society in association with some of our member firms conducted in the month of April and May. And that gave us sort of courage to hold these lecture series. So there has been a request from several article clerks, not only from your batch, but earlier through the years, to hold lecture series. As I have always maintained, this is a professional exam. This doesn't help you to get a rubber stamp against your name. It helps you develop your professional skills and professional knowledge of the subject. So this is only something to guide you with, something to take you through. Don't take it as a means to an end, because the means are always in your hands, and it's for you to decide how to study and how to improve your knowledge and go ahead to do the examination. But this is some kind of guidance from people who have given the exam in the past, the people who we have requested to speak to you are all members of our society, and they have given the exams, and they know exactly what these exams entail, and they've obviously been successful because they're all solicitors, so they know how to answer these papers. So it's a good understanding, but please don't hold anyone responsible that you told me to study this way, which I did, and now I'm not as successful as you when you pass the exam. So please understand that there's a disclaimer to this entire lecture series in saying that if you attend these lecture series, you will not necessarily pass the exam. But I must say that the people who we have chosen and who we will continue. So depending upon the interest which all of y'all are showing and involved in these lecture series, it will be a good idea to hold many more of these. What we're looking at is, this is the first round of them. There'll be, I think, 2 lecture series a week going forward. And we already have our members preparing for the ones coming up ahead. We're very thankful to Priyas Jani, who everybody in the society knows. He's a past president of the society, and he's presently on our screen. Priyas has been very helpful as part of our member of our managing committee to help us collate this lecture series. Of course, the managing committee, I must thank each and every one of my co-members, as well as the Honorary Secretary, Mr. Modi, who is responsible in organizing this, along with Farzana Madan and Mihir Modi and Darayas Dalal. So this is essential. Of course, I must also thank Bhavik Mehta. He's a member. He's from a firm called Dhruv Liladhar. He's been extremely helpful in setting up the logistics of these lecture series for us. And thanks, Bhavik, if you're on this screen today. Thank you very much for helping us out. And going forward, we are going to have not only these lecture series, but we're also proposing to have some kind of question and answer sessions as well. Not in this series of lectures today, but we'll have a second round of these and a third round if necessary. So I hope these are successful. And presently we are looking at it only from the article clerk's point of view, but we may, if it's helping everyone, we may extend sharing this kind of knowledge with other members of your law firms where you all are interned as well. So I'm very happy once again to start this, and I hope this continues. The greatest advantage of this is you don't have to come on a Saturday morning to the Law Society office and hear the solicitors lecture to you. This is very convenient, sitting in the at your home or at your office, and we hope to take use of this time as well as this technology to help each and every one of you. We'll be happy to receive suggestions from you as we go along. Just address it by email to Mr. Modi, to the Law Society directly, and we'll be able to assess everyone's suggestions and take this forward. So thank you very much for joining in. Please take advantage of these sessions, and I hope more and more of you join as we go along. May I now ask Nilesh to take over and explain some ground rules, etc., how you wish to conduct this further. Thank you.
Thanks, Kaivan. Thanks a lot. Hi, everyone. Welcome. Good afternoon. Hi, Priyas. How are you? Thanks for helping. Thanks for helping me with this. Priyas is Mr. Jani is the one who is handling sending the links to all of you and seeing that you can be on the screen. So thanks to him, and thanks to Bhavik for helping me with this. I don't know, somehow I have to keep admitting people again and again. I don't know how to do it automatic. So sorry for that. Anyway, coming to our today's series, as the president has said, we will be holding this series twice a week, Wednesday and Saturday in the afternoon. We have all solicitors as speakers on different subjects and topics from the syllabus. We'll keep announcing those, and I'll be sending those links again and again from time to time. So please keep that in mind and then join so everybody can take advantage of this. Now the whole purpose of this, sorry, just 1 minute. The whole entire purpose of today, this webinar series at present, is to just have lectures on the subjects. We have said no question answers. The reason being that we do not want, I have to keep doing this. We do not want everyone, to keep asking their personal problems or questions or solving the papers at present. Time doesn't permit that in this webinar. We do intend to have another session after this entire session of webinars is over, after this series is over, if time permits, of course, to have another session with senior solicitors and the speakers where we will deal with the paper's question answers possibly for the benefit of the article clerks. Obviously, the October people may not take that benefit, but the others can definitely take. The other thing is that we are recording this. You all don't need to record it. Please don't record it. We will be recording and then later on putting it on the website so that you can, if somebody has missed or somebody wants to revisit this lectures, they can do so. Please, as I have mentioned, kindly I have muted everyone, but in case somebody is not muted, please mute your mics. You can keep your videos on, but the idea is that there is no disturbance. And therefore, if everyone is muted, then I can at least, the speaker can speak properly and there is no disturbance. So let's start now. Now, as our president mentioned, there are some disclaimers. Whatever the speaker says on this is not that it's going to be a part of your exam papers or only from what he has said will be asked in the exam papers. You have to read your own on your own and see that you are thoroughly prepared. Do not go by that impression that because we are having this lecture series, whatever we are teaching here or whatever we are saying here is the limited thing within which questions will be asked to you. So please consider that also and keep it in mind that you have to study more than what is said in this. Speakers may also suggest things to you for the exam. Speakers may also recommend books for reading, but that does not mean that those are the only books recommended by the society and only from those books questions will be asked. You may have to read more, you may have to study and research more for this exam. The whole entire purpose of this exam is to prepare you for to be a professional solicitor and practice as a solicitor and be ready to answer your clients. So that is the whole purpose. Hence, don't just take it that this lecture series is just to pass solicitors and that's it. Once you do this, ultimately you have to study and pass and then practice as solicitors. And therefore, let's start with the first subject. I have decided to come with income tax as the first subject because I wanted to say all these disclaimers and also inform you that this series is basically to inform, to actually let the article clerks go through each and every subject which is part of our syllabus and understand them, and then they can study on their own better. So thank you. And now I will start with income tax. Now, as I have mentioned, that I am going to recommend or suggest that for income tax, in my view, you may read from whatever books are suggested to you, Singhanias or whatever, that is your personal choice. I would suggest to make it a little easier and simpler for you to read from Income Tax Ready Reckoner by V.G. Mehta, which is very, very lucid and in a simpler manner that a lot of sections are explained, so it becomes easy. Income Tax Act to read is very difficult, it is very complicated, and you may not remember things. Maybe there are smart people who may be able to read and digest from the Tax Act, but for most of us, this Reckoner would be a better option. It is V.G. Mehta's Income Tax Ready Reckoner. If somebody doesn't have, you may buy it. There is also another book called the Master Guide to Income Tax Act by Taxman, which also would be very useful to you for this exam because a lot of things are mentioned in this in a very brief manner, which will help you uh, understand and also learn that subject easy in an easy manner. Income Tax Act itself, the Taxman's Bare Act is also necessary. So these three books you must have for your studies. Now I'll be referring to you starting with our syllabus for this paper. We have a very limited syllabus for income tax. We have reduced our paper from 100 marks to 50 marks since 2019. And so now you have paper which has got partly corporate law, having SEBI regulations, and partly having Income Tax Act 50 marks. Now for this syllabus, we have chapters 1 to 7. Then chapter 9, 10, 10A, 13, 14, 15, 16, 17A, 17B, 17C, 19B, and 20. And there is only one section 281 in chapter 23. This is a limited syllabus. Now there are also situations where within these chapters, lot of sections, lot of chapters have been omitted over a period of time. So if those sections are omitted, you need not study them. It is not part of the act anymore, so that won't be asked, and that will not form part of the syllabus. For example, we start with chapter 1 to 7. There is one section, or rather one chapter, which is chapter 6 A. No, not say. One sec. Sorry, one sec. Yes, chapter 6B, which has been omitted. So you need not read the chapter at all. Section 80V, 80VV are also deleted from chapter 6. So I'm just trying to explain you that if they are omitted, then don't come and say, oh, even though it is omitted, it was part of syllabus. So we saw from the notes below in the Income Tax Act and saw the section and we studied that. Please don't study those things. Now, starting with the Income Tax Act. Income Tax Act is a act which is amended every year by the Finance Act. So every year the budget is pronounced. In that there are amendments made to the Income Tax Act by the Finance Act. So for the exam, what is the latest amendment you need to know? Now latest would mean that if you are giving an exam in April, then it would be 6 months prior to that. And if you're giving in October, it would be 6 months prior to that. Within those 6 months, you don't need to study. But you can glance through those amendments, because sometimes some examiners may ask a question. I am not saying it's a general rule. We do tell the examiners not to ask questions within those 6 months, but some may put in. So it is better you just glance through that amendments. The Finance Act and the amendments are given in brief in the VG Mehta's Ready Reckoner also, as well as in the Master Guide. So if you have that, you will find, if you have the latest edition of that, you will find the latest amendments in that. It is very easy to go through it. Coming to the Act, first section is of the definitions. And when you come to definitions, I'm not going to actually teach you and read all the sections and all the definitions, but I'm going to try and explain some of them and tell you which are the important definitions which you need to know. So for example, let me start with section 2. And in section 2, the first is advance tax, which is very important. There is also later on a chapter on advance tax payment. How do you pay advance tax? It also, there are installments in which you have to pay. And also TDS is one, which is tax deduction at source, is one type of advance tax that you have to pay, but indirectly. So these are the methods in which advance tax is payable. There is a chapter on that. But if you see the definition, it clearly says that advance tax means the advance tax payable in accordance with provisions of chapter 17C. So this is the chapter I was talking about for payment of advance tax. So some definitions are like that, that you have to refer to the chapters. Some give detailed definitions. Next definition, which according to me is important, is an SSE. Who is an SSE? Now, if you go through this section, it describes as a person. SSE is a person by whom any tax or any other sum of money, such as interest or penalty, is payable under the Income Tax Act, or in respect of whom any proceeding under the Act has been taken for assessment of his income or loss, or of the income or loss of any other person in respect of which he is assessable, or the amount of refund due to him or to such other person. It also includes every person deemed to be an SSE under Chapter 15. So again, this definition is referring to one chapter. Now, what this SSE is, not only a person who is accessible to pay tax, but also who would be entitled to a refund, also a person to whom a notice or a proceeding has been started against him, that why have you not assessed your income and why have you not filed the return. So even that person would be an SSE, and also a person who not only has to pay tax, but any penalty or interest. So this definition is quite vast and includes a lot of persons who has income, who has a taxable income, and is required to pay tax or penalty interest, or is entitled to refund, or some proceeding is against him. The next is block of assets. This block of assets is very important definition in our Income Tax Act, because not only depreciation in case of business income is calculated on the basis of block of assets, but even at times capital gains is calculated on the basis of block of assets. So as we go by, you will understand what is block of assets, but you need to know this definition. As I said, I'm not going to read each and every definition. It is for you to study. You have to study all this. I'm just telling you what are the important definitions. The next one is business. So business is also defined to include any trade, commerce, or manufacture, or any adventure or concern in the nature of trade, commerce, or manufacture. Then we have capital asset. Again, a very important definition. This would determine two things. If there is a capital asset, then you will understand what is capital gains. If there is a capital asset, then you will understand what is a capital expenditure. So considering that, this definition is very important. It's a quite a large small definition, because capital asset includes property of any kind held by the SEC, whether or not commercial with his business or profession, any securities held by foreign institutional investor which has invested in such securities in accordance with the SEBI regulations, and but does not include any stock in trade other than the securities referred to in subsection B, consumable stores or raw materials held for the purpose of his business or profession. So anything and everything would be asset, capital asset, so long as it is not a stock in trade or a raw material or something which is a consumable for himself or stores, and also would not include any securities held by any foreign institutional investor under the SEBI regulations. Then we go to charitable purpose. Now, charitable purpose is a definition which connects to sections 10 onwards, section 11 onwards, 11 onwards, which are the sections relating to assessment of trusts, private trusts as well as charitable trusts. And therefore, you should know what a charitable purpose is, so that you can advise any charitable trust or trustees who may come to you for any advice on tax. Then we have another definition, which is company, which is an important definition. which is section 2, subsection 17. It is quite a large definition. Then there is dividend, section 22. What is dividend? At one time, dividend was tax-free. Now, from this year, it has become taxable. So, dividend is something which you need to know what includes dividend and what doesn't include dividend. Section 22, subsection 22A, section 2, subsection 22A, which deals with domestic company. There are a lot of definitions in the Income Tax Act dealing with different type of companies. There is a domestic company, there is an Indian company under section 226, there is a foreign company, public sector company under section 236A. So you need to know all these different type of companies. Foreign companies under section 223A. So these definitions of companies you need to know. Then fair market value, which is section 2 subsection 22B. Fair market value is very important for the purpose of capital gains, because now if your asset that you sell, capital asset that you sell, does not fetch the fair market value, then you would have uh, issues with that. You will have to end up paying tax. I will come to that when we deal with capital gains. Subsection 23 of section 2 defines firm. There is a separate chapter in the Income Tax Act dealing with taxation of firms, which I will come to. That's why this definition is important. One of the most important definition is income. Section 2, subsection 24. The entire act is based on this, basically, because unless you understand what is income, you won't know what is the tax payable on the income. Therefore, this definition again is a large definition, and you need to go through this. It runs into at least four pages. Like dividend, there is interest, which is defined under section 2, subsection 28A. Then we have legal representatives under subsection 29 of section 2. Sorry, before that, there is a difference between interest and interest on securities. So interest on securities is separately defined in this section 2, subsection 28B. So you must know the difference. You must read those differences, why they are both different. Do not get confused in both these definitions. I was coming to legal representatives, which is subsection 29. This is very important. How legal representatives are representative assessors under the Income Tax Act, or how they can take benefit of certain provisions in the Income Tax Act being legal representatives. Like in capital gains, there is a benefit of long-term capital gains which you can take on the basis of the asset owned by the deceased person. The legal representative who gets the asset or the legal heir can take benefit of that under the Income Tax Act, under the capital gains tax. I will come to that. That's why legal representative is also important. Legal representatives would include executors, administrators, and heirs who have obtained that representation. And they say that the meaning is as per CPC. So you will have to refer the definition to CPC for the meaning. We have next section, which is long-term capital asset and long-term capital gain, which are subsections 29A and 29B, again relating to capital gains, which is one of the heads of income in the Income Tax Act, which I will come to. 29C is maximum marginal rate, which is a very important again, because unless you know what is maximum marginal rate of tax, you will get confused why it is being levied in some cases and why it is not being levied in some cases. Then there is a definition of non-resident under subsection 30. Who is a non-resident? A non-resident means a person who is not a resident, and for that you have to see, for the purpose of section 92, 93 and 168, it includes a person who is not ordinarily resident within the meaning of section 6 subclause 6. Now this basically will be coming next to who is a resident, who is a non-resident, who is a resident but not ordinarily resident. Taxation laws are based on that. People are taxed on that basis. A person is very important because person will doesn't mean only an individual but includes an HUF, a company, a firm, an association of persons, a body of individuals, whether incorporated or not, a local authority, and every artificial juridical person not falling within any of the preceding subclauses. So it is a wide definition. In law, sometimes we say that a firm is not an entity in law. It is only recognized by the partners. But in income tax, this firm is also an entity in law, and for the purpose of taxation, it is a separate entity. Same is the case of HUF. Association of persons or body of individuals would include, say, trust, where there are trustees. There would be association of persons. There would be cooperative society, which is also incorporated under the law and a separate entity. This would also come under body of individuals as an incorporated body. So there are these different type of organizations and bodies which are included in the definition of person for the purpose of taxation law. The next is subsection 32 of section 2, which is person who has substantial interest in a company. In relation to a company is a person who is beneficial owner of shares, not being shares entitled to a fixed rate of dividend, whether with or without a right to participate in the profits, carrying not less than 20% of voting power. This definition is also important because later on there are chapters which are dealing with a person who has substantial interest in a company and how he is taxed for having that interest. Therefore, that is also an important definition. One more important definition is previous year. Now this, we will come to the next section, which is section 3, which defines previous year. So I'm not dealing with now. Then there is public sector company, as I told you earlier. Then we have subsection 40 of section 2, which is regular assessment. Now that is also as defined separately under section 43 or section 144. And then we have relative under subsection 41. Now relative in relation to an individual means the husband, wife, brother or sister or any lineal ascendant or descendant of that individual. This subsection is also very important because in lot of other sections of the Income Tax Act, there is reference to relative. And in some sections, relative is again defined separately. Here it is defined separately. So wherever it is not defined separately, this definition applies. And say, for example, clubbing of income, which I will come to. A relative is not defined there, it is defined here, and whatever income or an asset is transferred to a relative, the income is clubbed in the hands of the person who is transferring or in the income of that person. So this definition is also very important. The next definition is resident. Again, as I had said, we have a definition of non-resident, then we have definition of resident. Both are again in section 6. We'll come to that. Again, short, like we did long-term capital asset and long-term capital gain, we have short-term capital asset and short-term capital gain defined in subsections 42A and 42B of section 2. And then we have subsection 42C, slum sale. This is also very important definition because it deals with sale of undertakings. And you can read this definition. It is very important. This could also be asked a short note, this section, the subsection, what is slum sale? So that's why I'm saying it's important. Then the next definition is of tax. And after that, subsection 43, tax credit certificate. The next very important definition is total income, which is subsection 45. Total amount of income referred to in section 5, computed in the manner laid down in this act. So you have to compute the entire income as defined in section 5, which would be your total income. And on that basis, you have to file a return of income. So this definition is also important. One of the other important definitions, which I am referring to, is transfer under section 2, subsection 47. This is again a very important definition as a solicitor to deal with for capital gain purposes. People come to you for sale of flats, sale of other properties. There, if this is a capital asset and person has to transfer that for the purpose of capital gains, this definition is very important because you should know what is transfer. Transfer in relation to capital asset includes the sale, exchange, or relinquishment of an asset, or extinguishment of any rights therein, or compulsory acquisition thereof under any law, or in case where the asset is converted by owner thereof into or is treated by him as stock in trade of a business carried on by him, such conversion or treatment, maturity of redemption of zero coupon bond, any transaction involving the allowing of possession of any immovable property to be taken or retained in part performance of contract of nature referred in section 53 of Transfer of Property Act, any transaction whether by becoming a member or acquiring shares in a society, cooperative society, company or other association of persons, or by of any agreement or any arrangement or in any other manner whatsoever which has the effect of transferring or enabling enjoyment of any immovable property. So this definition not only it relates to Transfer of Property Act, it relates to Registration Act because Registration Act also deals with sale, extinguishment, relinquishment, exchange. It also relates to Transfer of Property Act, compulsory acquisition, so therefore Land Acquisition Act, and also cooperative societies, holding of shares in a society. Therefore, this definition is covering a lot of aspects which would give rise to capital gain and therefore result in capital gain tax. So keep this in mind. Now, after the definitions, we will now come to the Basic Act. Now, Income Tax Act basically is a charge or tax on the income which you earn during a year, and you have to then file a return in the next year after your year is complete. Therefore, they have defined what is the year, and that year which is a taxable year would be a year in which you are filing a return and that is the year in which you will be assessed. But that relates to a year prior to that. Therefore, it is the previous year. So you say you earn income this year in 2020, then your assessment year will be next year 21, and therefore this is your previous year and that is your assessment year. This is the basic concept of section 3, which is previous year. For the purpose of this act, previous year means financial year immediately preceding the assessment year. So one is a financial year. Now, earlier in years back, everybody could have a separate previous year. Your assessment year would always be from 1st April to 31st March of the next year. But your previous year could start from Diwali and end on Diwali, could be January to December, or could be any year. Now they have said that no, your assessment year, if it is April to March, your assessment year should also be the previous year from April to March. So they have brought in this back. So previous year is a year which is prior, 1 year prior, a financial year prior to your assessment year. And the assessment year is the year in which you will be assessed to tax. You have to file your return, and every proceeding relates to that assessment year. Then for charge of income, how is an income charged in a year? So the Act charges your income on the basis of your total income in the financial year and which you have filed in the return. After that, you get your deductions, your exemptions, and whatever is your taxable income, on that you are taxed. That is what basically the charging of income section 4 states. It will be charged for any assessment year at any rate or rates. Income tax at the rate of those rates shall be charged for the year in accordance with and subject to the provisions of the levy, including provisions of levy of additional income tax of this act in respect of the total income of the previous year of every person. In respect of income chargeable under subsection 1, income tax shall be deducted at source or paid in advance where it is to be deducted or payable under the provisions of this act. So it is a tax at source, which is TDS. So at source, a tax is deducted. The person who is paying deducts that tax before he pays you and deposits in your treasury. On that basis, you get that amount of tax which is already paid in your return on the basis of your return of income, and you can show that this is already paid. So to that extent, you pay less. Same way is advance tax, where in 3 installments you are supposed to pay advance tax. So when you pay 3 installments of advance tax, you are paying that tax in advance in the previous year itself before filing your return of income. And when you file your return of income, if there is any shortage, you pay self-assessment tax. But otherwise, you have already paid your tax in advance. So the charging of income also includes this. Now, income tax basically is chargeable under the different heads of income. And the Act proceeds to first define the scope of the total income, and then it goes on the residential status of a person and how the tax will be charged. So section 5 deals with the scope of the tax, and section 5 scope of income tax says that person who are resident or ordinarily resident are chargeable to tax on all income which is received or deemed to be received in India. Therefore, not only received, but suppose it may be an assumption that you are going to receive, you are still charged on that. Which accrues or arises or is deemed to or accrue or arise in India. So not only which is received or deemed to be received, but also which accrues. So actually you have not received, but the income has arisen to you. A dividend or dividend is declared by a company, the income has arisen. Whether you receive it or not is immaterial, you are still taxed. Which accrues or arise outside India, also you are taxed. But so long as you are a resident and you earn any income outside or that income accrues to you, then you have to pay tax even on that. Then in respect of husband and wife governed by system of community of property under the Portuguese civil code. Now this is applicable to Goa, in Goa and union territories of Dadra and Nagar Haveli. Income of husband and wife except salary income is to be apportioned equally between them and assessed separately. Why this is so? Because under the Portuguese law, there is a presumption or there is a provision which says that once a person gets married, whatever assets he owns, his wife owns half of the assets. And therefore, this provision is given that insofar as Goa is concerned, and there is an income from that properties, then it should not be taxed only in the hands of the husband because he owns it, but it will be divided half and half. Now, the scope section also refers to liability of persons who are resident but not ordinarily resident, as it's the same of a resident and ordinarily a resident, except that income which accrues or arises outside India is not included in his income. So the difference between an income earned by a person who is a complete resident of India and a person who is a resident of India but not ordinarily residing. And what does this mean? This means that suppose a person has gone abroad, say to Dubai, and is doing a job there, then because the number of days he is going to stay abroad, which will come to, he is treated as a resident of India, but not ordinarily resident, or if his numbers are more, then he may be a non-resident Indian. Considering that, suppose a person is going from here on tours abroad through his company to other countries for his business, and the number of days he is though resident in India, but the number of days are such that he exceeds that number qualified to be a resident, and therefore he is a resident but not ordinarily resident. The income in such cases, the only difference between resident and such person would be that insofar as the income which he has earned abroad would not be included in his return here if he is a resident but not ordinarily resident of India. Non-residents are liable for income received or deemed to be received in India, or which accrues or arises or deemed to accrue or arise in India. They are not liable in respect of income which accrues or arises outside India, even if it is remitted to India. So a person who is a resident, now do not confuse yourself, a non-resident Indian with a foreigner. A person who has a foreign passport is not a non-resident Indian. A person has to be first a resident and then non-resident by way of virtue of the definition here. Now then there is a provision irrespective of residential status, all income accruing or arising, whether directly or indirectly, through or from any business connection in India, any property in India, any asset or source of income in India, transfer of capital asset situated in India shall be deemed to accrue or arise in India and chargeable to tax in India. Now this section also includes foreigners. If a foreigner earns any income in India by way of salary or whatever way you say, business or selling any asset or anything, they would be governed by this section and they would become taxable. So please go through this scope of income. I have explained what is the scope basically, how it includes, but it also includes a lot of other things. The ready reckoner which I was referring to explains this very lucidly and in brief. It could be very useful to you for the purpose of your answer. If there is a question on this, then what is the scope of uh, chargeability of tax under the Income Tax Act? Now, I will go to the sections relating to, I will read the relevant portion relating to SSE assessment year, and then ordinary residential status. So SSC I have already dealt with earlier, subsection 2. Assessment year also I have dealt. Assessment, now assessment. As far as assessment is concerned, Income Tax Act does not prescribe the rates, but the Finance Act actually prescribes the rate at which the tax is levied. So there is always an amendment in the Finance Act. If there is no amendment, the previous year's tax structure continues. But if there is an amendment, it will be charged according to the rate which comes in the finance year. Then coming to residential status of an SSE. As we have discussed, one is resident in India, one is non-resident in India, which would include not only individuals and HUFs also. And then they are classified into ordinarily resident and not ordinary resident. So what is an ordinary resident of India? There is two different things. One is individual and one is HUF. And then there is resident of a company. Then there is, so now first dealing with individuals, uh, Income Tax Act basically defines how an individual would be resident. So if he is in India for a year or a period of periods amounting in all to 182 days or more. So out of 365 days, if you are in India for more than 182 days, you are resident. Then in the 4 preceding years, you have been in India for a period in all to 365 days or more, and has been in India for 60 days or more in that year. So in the 4 previous years, totally you are in India for 365 days, and then for 60 days in the current year, then you are a resident. Now, when you are, same is the case for HUF. In case of HUF, it refers to the karta or the person who is in control and management of its affairs. So if your person who is in control and management, the same rules apply of 180 days or 365 days and 60 days. Now, if you're not complying with these rules, and if you're out of India for more than 182 days, then you would be a resident but not ordinary resident. Now, what is in case of a company? If you are an Indian company, then you are resident, and or in place of effective management. So if your company's effective management in relation to any assessment year after 2017-18 and subsequent years during the year, the control and management of his affairs is situated wholly in India in relation to that, then you are a company resident in India. Now what about non-resident? An individual who does not satisfy both the conditions mentioned in for a resident, then he is a non-resident. So a person who is neither a citizen of India nor a person of Indian origin was in India for over 365 days during financial years. However, he did not visit India during the financial year later on except for 59 days. So he doesn't complete 60 days. then these both conditions are not complied with, then he is a non-resident. So he may be a foreigner, but if he is complying with either staying in India for 182 days or the compliance of 365 days in the previous year and less than 60 days, then he is a non-resident. But if he completes 60 days, then he becomes a resident, but not ordinary resident. HUF, again, it applies to the person in control and management. A company will be treated as non-resident if it is not an Indian company, and it says and also if it is place of effective management in that year is in India, if the control and management of his affairs is not situated wholly in India in that year relation to 2016 and 17 or previous years. Now, not ordinarily resident in India in respect of individuals, it may be noted that under the Income Tax Act, status of not ordinarily resident in India is accorded only to individuals and HUF and not to companies. And accordingly, remaining category of SSEs are classified either as resident, which means ordinarily resident, or as non-resident. So now they have classified only two, either you are a resident or a non-resident. As far as individuals and HUF are concerned, for them this rule applies of number of days. Otherwise, for the companies and other SSEs, it only is either resident or non-resident. I hope I'm clear in that. Don't get confused. For individuals and HUF, the policy of the number of days applies. For companies and all, only both categories applies, and there is nothing like ordinary but not ordinary resident in India for companies or other SSEs. Then we move to sections 11 onwards, which are dealing with, no, first section 10. Now 10 I'm not going to go through because 10 basically are exemptions. The entire list of uh, incomes which are exempted from tax, there is no tax on that, is given in section 10. And that again, you can refer to the master guide, which has a list, as well as the ready reckoner, which has a list of what is exempted. So I'm not going to deal with that. You can learn, questions are asked, name any 5 or 10 exemptions and you can answer them. So some of them you can know. Same is with section 80, which I'll come to. 80 are deductions, what you can deduct from your income. There's a whole list of that, and some are there, some are not there. But I'm not going to go through that. That list you can go through in the Income Tax Act or the Master Guide or the Reckoner, which it gives you the sections. Only some I may deal with later on. Coming to sections 11 onwards, this deals with trusts. Now, if you see, trust is a separate entity. Trust is like a representative for the beneficiaries. So trustees or trustees are regarded in two categories. One as a representative SSE for private trusts, and a charitable trust is an entity by itself. Now, because charitable trusts are trusts which are have the objects, benevolent objects of maybe various charitable purposes or a religious purpose. The assessment of this is done separately. A lot of exemptions are given to them, but now slowly they are removing these exemptions because they are finding that a lot of charitable trusts are misutilizing their objects and not disclosing their true income. They have found that a lot of donations come in cash, which they are converting and showing it as donations and then earning income out of it. Or say there is a trust which is running a dharamshala and they are charging people for that. So that kind of income, they are now saying that this may be objects of charity nature, but you are actually earning income. Some charitable trusts are also doing business of different kinds. So they are also earning income. So they are saying that if you are earning income, then you should pay tax. So that's how it is changing. Trusts, otherwise private trusts are family trusts where there are trustees or beneficiaries, or other private trusts where there are beneficiaries. Those are separate entities. Those are coming under representative assets where either the trust is taxed or the beneficiaries are taxed. One of them is taxed. You cannot escape tax there. They are treated different from charitable trusts. Most of the sections 11, 12, 12A, 13 deal with how a trust income is to be charged or how it is not to be charged, and how much exemption can you get. And relating to section 11 to 13A and 13B, 13 and 13B relate to income of political parties and electrical, income of those people, political parties and all that. But section 11, 12, 12A and 13, which relate to trusts. Also, there is a reference to that section 80G, which is a donation. So suppose a person, a charitable trust has got a 80G certificate and a donation is given by any person, then to the extent of 50% of the amount which the person has given as donation, he can take a deduction in his personal income. So it is related. Same way, there is another section, section 100, which is a donation to, say, Prime Minister's Relief Fund or some funds which has 100% deduction. So those sections give benefit to a person to donate and take benefit of paying less tax by taking that deduction in his income. So you can go through these sections relate to basically how sections 11, 12, 12 and 13 relate to how a charitable trust is to be assessed and what is the income included, what is not included. 13 and 13B, as I told you, is relating to income of political parties. Now we come to basic heads of income. Now heads of income, there are 5 heads of income under which you are taxed. So first head of income is salaries. Now this section of salaries is a person who is who is earning salaries, employed with some company, some firm, somewhere, or a person. Then, so for salaries, uh, the income from salaries also includes perquisites, benefits, fringe benefits that they get, which is defined in the Income Tax Act in the sections. Uh, I will just go through them briefly. Section 1. So salaries would include salaries what you earn, plus the perquisites, wages, annuity and pension, gratuity, any fees, any advance salary, any other payment received, and bonus, commission, dearness allowance, compensatory allowance, and whole lot. And then there are perquisites and other benefits, all of which is included. The salaries, head of salaries is basically sections 15, 16 and 17, which define what is salaries and what is the income, what is not income, what are the statutory deduction you will get. So under salaries, because you are in income, you get a statutory deduction, because you get other deductions, like if you have invested your funds in any provident fund or in any uh, other investments, then you get those deductions under your income and you pay that much less salary. So one is this head of salary. So you go through this, there is profits in lieu of salaries, there is salary of foreign technicians. Now in deductions of salaries, we have standard deduction, as I told you, which is section 16, 1A. Then you have entertainment allowance, which you get deduction. Then you have deduction of TDS. Now TDS again is related to this. For every income there are different TDS, but an employer, before paying salary, if the person who is employed is falling within the taxable limit, is required to deduct TDS from the salary and deposit it in the treasury. Now, why I'm referring to Reckner, because Reckner and Master Guide, when you refer to these books, they give you topic wise notes. So while Income Tax Act has different sections at different places and it is very difficult to correlate each with the other, this Reckner gives you a brief idea. Suppose it is salaries, whatever is related to salaries is given under one note. So anything related to salaries in the tax will come under this one note. So it becomes easier for you to refer to that. After salaries, the next head of income is income from house property. Now, income from house property should not be confused with income by way of capital gains. House is a capital asset, but when you sell that and you earn income from that, that is a gain that you earn, which comes under the next head, which is capital gains. Any sale of a capital asset and you earn income is a capital gain. That does not form under this income from house property. Income from house property would be rent or license fee if you are given on leave and license, or if you are using the house for business or profession, then there would be a deemed income and you may be chargeable. So suppose you have two houses or three houses and one house is lying empty and you have not given it for on leave and license basis or anything, and it's just lying empty, but still there would be an income on a deemed basis that look, you are earning there. So that is how they will charge under income from house property. Suppose that those sections are 22 to 27, income from house property. A house property would consist of building or land appertaining thereto. Land may be in a form of a courtyard or a compound forming part and parcel of the building. Such land is to be distinguished from a purely open plot of land. Any rent received from such vacant plot is not accessible to income from house property, but income from other sources. So if you don't have any house, but only a vacant plot of land which you have leased and you earn rent, that is not again to be mixed with income from house property, but it will be treated as income from other sources, which is the fifth head of income. Then house property used for business or profession is excluded. Suppose you are using a property for your running your business, that would not mean that there is some income from this, and the income from what you earn in the business is your income from house property. That is a separate business income, which is the next head we will come to. So this should also not be confused. You can claim depreciation in respect of such property from your income. Coming to now the next head of income, which is uh, property profits and gains of business and profession. Now this, again, you go back to the definition of business, which I had told you. Business is defined under section 2, subsection 13, and profession is defined under subsection 36 of section 2. So business income, whatever you earn from your business, is brought under this head. It could be income or it could be profits. If it's a business, it is profits. If it is a profession, it would be income. Out of that, you will have certain deductions which are given in this, the sections relating to profits and gains of business. are sections 28 to 44 DB. Now, a lot of these sections are important, and I will just briefly tell you which are the important sections in this. One is section 32. Of course, section 28 is important, but section 32 deals with depreciation. So what assets are owned by your business, like computers or tables, furniture, fixtures, or maybe plant and machinery. Whatever is owned, you will be entitled to depreciation. So to that extent, you can claim relief in tax by showing depreciation in your returns. Then 32A, investment allowance. How you can take benefit of investment allowance if you have made investment in plant and machinery or certain assets. There is provisions in this under section 32A. You can get that benefit. You are taking allowance for that. Then you have section 32AC for new plant and machinery. Section 34 are the conditions for your getting those benefits. Section 36, bad debts, and 36(2). Suppose you have bad debts, you can claim deductions. You have paid bonus and employees to your employees. If you have paid bonus and commission, then you can take that deductions, salary deductions. So all kind of expenses that you incur. As a solicitor now, if you have incurred your office expenses, administration, then those. Now coming to books, as far as lawyers are concerned, books are plant and machinery for them. So that is an asset for them. Now, if that is an asset, there is a bifurcation. It could be a capital asset and it could be an expense. So the difference between this is when it is a capital asset, when you buy a book, say a book on income tax, which is not published every year, but say Income Tax Act by Nani Palkhiwala's Income Tax Act. That goes to your library and you preserve it for many years. That is your capital asset. That is a long term. But Income Tax Act, Bare Act of Taxmen, or this reckoner, which comes every year and you have to again buy every year, then that is a recurring expense and that becomes your business expense and you can take a deduction. But for that capital asset or library, you have to claim depreciation. This is the difference. If I have made you understand. Suppose I have bought a book on transfer of property of Mullah, then that book I have to capitalize it. I have to treat it as an asset, and on that I can claim depreciation. And if I buy a Bare Act or a Stamp Act or a Transfer of Property Act Bare Act from Snow White, which I buy every year a new edition, then that becomes a recurring expense, and that is a business expense or a professional expense which I can claim as deduction in my income in that very year. So this difference you must understand how these deductions in business income are made, so you can advise your clients accordingly. These details we are not going through of how, and we are just telling you heads of income because you are not going to be asked to actually prepare a return of income. You are not a chartered accountant. In your papers, you should know what are the heads of income, what kind of deductions you can get, because questions are asked on those bases. You don't have to compute the return of income, but these are necessary. What are the general deductions that you get? What are these bad debts? What is how you get depreciation, so that if you have a problem which is asked in your papers, you can answer those on this basis. So you can go through this head of income. Then there are a lot of expenses. Now, one section in this is 44AB. No, sorry, 34A, which is unabsorbed depreciation and investment allowance. So sometimes it happens that certain depreciation that you claim, because your income is not enough, the entire depreciation you cannot claim. There are limits to the amount of depreciation you can claim in 1 year. So if it is unabsorbed, you can carry forward it to the next year. Same is with investment allowance. Investment allowance, if you made a huge investment, your income is not there, then you can take it in installments in subsequent years. So this provision is also there. Then uh, section 35 deals with research expenses. Uh, 35 deals with patents and copyrights. Then 35AB deals with know-how. Then these sections are also again very important. Section 35D, amortization of preliminary expenses. Many a time short notes are asked for this. What is amortization? If you want, it's a short thing, it's a long thing, so I'm not going to explain, but you can read it. If you have queries, you can contact me, I'll explain to you. Not a difficulty, but I don't want to deal with it. You can go through it. It is very important. Uh, then you have 44AB, which is audit. When a business or a profession, the tax return what he files are required to be statutorily audited. That is provided in 44AB. So if you have an income as defined in 44AB, then it is compulsory for you to have your accounts audited before filing your return of income. So these are the important sections of under the head of business and professional income. Then we come to capital gains, which is, in my view, one of the most important for a solicitor, because day in and day out, if you're dealing in transactions of sale and purchase of properties, or doing mergers, amalgamation, whatever, your issue of capital gain always arises, and you should know this so that you can advise your clients on this. Capital gains is basically, as I told you, based on the definition of capital asset. What is a capital asset? And then definitions of long-term capital asset, short-term capital asset. Therefore, and what is long-term capital gain and short-term capital gain, as well as the definition of transfer under section 2, subsection 47, which I had read. These are important so that you know what you are dealing with. Capital gains basically is any profit or gain arising on sale of capital asset. To arrive at that, you have to know what is cost, and you need to know what is your sale price, and considering that, what is your gain. Now, in capital gain, there is a deeming provision, because earlier people used to deal a lot in black money in transaction of sale of properties. Government has tried to arrest that, and that is how they have brought in this section where they say, section 50C, which says that for the purpose of sale, if for the purpose of calculating your capital gains as such, they will take into consideration what is the fair market value of your property. That's why I was referring to the definition of fair market value earlier. Fair market value would be the value as per your reckoner, stamp ready reckoner, not this ready reckoner, the stamp ready reckoner. So when you sell your property and make a sale document, and when you go to register it, the stamp people will calculate what is the value of that property according to their reckoner. If your sale price is more, there is no issue. If your consideration is more, there is no issue. But if your consideration is less, then the stamp value will determine what is the market value, what is the fair market value. That value you will get from the stamp duty that you paid on the agreement or the transaction, the sale document. And once you have paid that, from that, the tax guys will know that your fair market value is higher than your sale consideration. So the difference between that will be treated as undisclosed income, and therefore you will be taxed on the fair market value and not on the consideration amount which is mentioned in your agreement. So this is what you have to be very, you should know, and this is what you should learn, because you have to advise your clients on this basis that, look, if you're doing a transaction, never do a transaction where your consideration is less than the fair market value. And if it is less than fair market value, you have to be ready to explain it. Of course, they have said that if the difference is not more than, I think 15% or something, it is permitted. But otherwise, it is not permissible. So that is where you should look into capital gains. Capital gains also, if you go through the provisions of sections 45 onwards, 45, 46, 47, 48, they deal with what kind of assets, when does capital gain arise. There are a lot of deeming provision. It is not only when actually a property is sold, but there are deeming provisions where there, suppose a property is transferred, like in 247 it says, a man owns a property, he becomes a partner in a partnership firm and transfers the property and treats it as a uh, asset of the firm. There is a deemed transfer. So even if monies are not exchanged, there is a deemed transfer and capital gain arises. Similarly, is the case when a firm dissolves and the asset goes back to one partner. So these are the provisions which you need to know. And capital gain, what it includes and doesn't include is mentioned in subsection 240, subsection 14 of section 2, capital asset. Then transfer, as I told you. Now, what I was trying to tell you is the transactions not regarded as transfer, which is under section 46. So certain transfers will not be regarded as transfer, certain transactions like distribution of assets by a company to its shareholders on its liquidation. There is no capital gains. Distribution of capital assets on the total or partial partition of an HUF. Any transfer of capital asset under a gift or a will or an irrevocable trust. So there are these, they have defined as to what kind of transactions there will not be regarded as a transfer and therefore not be regarded as as a transfer of capital asset, and hence no capital gains will arise in this transaction. You need to go through that. Then there is how you have to compute your capital gains by finding out what is the cost. Now in cost there is indexing. So if your cost, now that again recently they have changed the definition of indexing, from which date you have to index and how you have to index. Earlier it was 1981, you had to take a value. If your asset is owned prior to 81, you have to take 1981 value and then index. Indexation is basically the price of a rupee, how it has inflated. That is what is the indexation value. That is also given every year, it keeps increasing. And now under the new law from 1819 assessment years, the date from 1981 has changed to 2001. So you have to take the value as on 2001, 1st April 2001. And any asset which is owned prior to that, either you can take that cost or you can take this cost and then index it according to the indexation and come to your cost. The cost is then minus from your sale price or the fair market value, and whatever you earn is your gain. But from that gain, there are certain expenses which are deductible. Like if there is an improvement to the asset, suppose there is a tenant staying and you have paid a tenant to remove him before selling that property, then that is an improvement. So you can deduct that amount. Suppose you have paid stamp duty, then that is also an improvement, or it's an expense for that transaction. So you can deduct brokerage, you can deduct legal fees, you can deduct. So these expenses you can deduct to bring down your gain. then you can invest your gains in certain investment like bonds up to certain limits as specified in section 54, 54E, 54F and all those sections, so that you don't have to pay capital gain tax. This is to save your capital gain tax. So these also you should go through, because you have to advise your client where he can save capital gain tax. For example, a person has bought a property out of the money which he has got from the sale of his old property, then that he can take benefit and he can claim exemption of paying no tax at all. There is an example in case of tenancy conversion. A person is a tenant, the building goes for redevelopment. The builder is giving him a new premises, a new flat on ownership basis. Now, what happens there? In that case, the Income Tax Act uh, proceeds on an assumption that your tenancy is of zero value, and whatever is the price of the new premises is your gain. Therefore, you have to pay full tax on that amount. But no, what Income Tax Act says is, and there are judgments to that effect, a lot of judgments, that once you have treated, you have converted tenancy to ownership, then whatever gain you have earned, that is the value of the new premises, is again reinvested by you in that new premises, and therefore there is no tax. So merely conversion of tenancy to ownership, there is no capital gain tax is not the issue. The issue here is that tenancy to conversion to capital to ownership flat, there is a capital gain tax, but because you are reinvesting under 54, there is no tax. Understand? So that is how it applies, and therefore when tenancy is converted to ownership, there is no tax at present. So this is how you deal with capital gains. Very important for you. You should know, a lot of questions can be asked on this. Then the last head of income is income from other sources. Now that is anything but what not falls within the first four heads. So whatever is not falling in the first four heads will come under this head. That is what is provided in section 56. Every kind which is not to be excluded from the total income and which is not chargeable under any of the heads specified in items A to E of section 14 shall be chargeable to income under the residuary head income from other sources. So this would include dividends or winning from lotteries, crossword puzzles, income from interest on securities, income from machinery, plant and furniture let on hire. Like if you have car rental, that would be your business, but you should not mix your business income with this. Like I had explained earlier, that when you let out your house on leave and license, it will be income from house property. But if the house property, if the land is vacant and there is no house, then the income which is there from that vacant land or the rent that you receive on letting out your vacant land would fall under income from other sources. Anyway, these are all the heads. So when you have to see what is your total income, you have to calculate your income under all these heads and then come to your total income and then claim your deductions or exemptions as applicable, and then whatever is the net income on which you have to pay tax, you will be charged tax on that basis depending on what is your income. Now, Income Tax Act further deals with certain different type of incomes, which is actually not the income of a particular person, but the income of somebody else, which is called representative SSC or clubbing of income. there are provisions in which certain times income people try to avoid payment of tax, and therefore they try to transfer properties or try to transfer the income to somebody else. And therefore in such situations the Income Tax Act provides that income of the person who is actually not the beneficiary, but he has tried to transfer it to somebody else, will be clubbed in his income. For example, I transfer an asset to my wife and then she lets it out on rent, only with a view because my income bracket is high and her income bracket is low. So she can earn income and I therefore gift it to her. If I do that, then the income earned by her will be taxed in my return and not in her return. This is what is clubbing of income. So these provisions of clubbing of income are under chapter 5, which is part of your syllabus. And you should know what is clubbing of income, because a lot of times questions are asked on this clubbing of income. And I will briefly just mention those. These are sections 60 to 65 of the Income Tax Act. The income of other persons deemed to be the income of the person sought to be taxed. Income arising to all persons by virtue of transfer, whether revocable or not, and whether effected before or after commencement of the Act, shall, where there is no transfer of asset from which the income arises, be chargeable to tax as the income of the transferor shall be included in his total income. So I don't transfer the asset, but I only transfer the income. So I have shares in my name, but the dividend goes to somebody else, that kind of situation. Then revocable transfer of assets. If a person transfers an asset which can be revoked by him, then that income would be included in his income. Then a trust which is not revocable. These are exclusion. Then income of individual to include income of spouse, minor child. Like I said, I gave you an example that if I transfer something to my minor child, then income earned by him will be included. But there are also again certain exemptions in this and exclusions in this. So you can go through this. Then the next is set off and aggregation of income and set off and carry forward of losses. Now this is also an important topic. You have to understand that sometimes people have loss, sometimes in business it could be business loss, and if they have to carry forward, where do they carry forward? It can also be a capital loss. Say a car is purchased by you for 5 lakhs and then you sold it for 1 lakh. So obviously after depreciation also your book value may be less, but if you have not received even your book value, then you have sold it at a loss. Suppose you may have sold it at 20,000, 30,000. Then this kind of loss is called a capital loss. And how you can take benefit of the setting it off against your other income or against the income from a new car, in case you are your business is to hire cars. So all these provisions are mentioned, and either you can set it off or you can carry forward that loss. So there is a difference between setting off loss and carrying it forward. The same difference that we have in CPC, where we have set off of claims or we have counter claims. Then we have deductions under section as chapter 6A, which is all deductions under that chapter. Section 80, which I said there is a whole list, you have to go through it and learn those. Some of them, at least the important ones, would be 80G. 80C is no longer important, but 80L is important. ATDD, ATEE. These are some of the important sections in that. Then we have uh, in our syllabus chapters which have been recently, not very long back, introduced for taxing in case of foreign transactions, taxing in case of double taxation, where a person is taxed for the same income in India as well as abroad. For example, a non-resident or a foreigner who owns a property in India. Foreigner, I mean, and a person having a citizen of abroad, a foreign country, but of Indian origin, because only they can own assets, or a company here owns an asset. A foreign company which has a base in India owns an asset, something like that. So that if whenever those people sell those assets and they are liable to pay capital gain tax, then uh, automatically they are taxed here as well as sometimes also in their country. So they are taxed double. So there are these treaties, double tax treaties with different countries where they have come out with agreements that if they are taxed here, then to the extent of how much tax is paid here, they get deduction in that country or vice versa. And you can take benefit of that. So the chapter relating to relating to double taxation relief is chapter 9, sections 90 to 91. Then there is a chapter 10, special provisions relating to avoidance of tax. Now this is relating to transfer pricing and arm's length deal with foreign transactions. So these sections have been introduced to curb. There have been times when people do business abroad, they generate income abroad, though they are based in India. But say that since these are incomes abroad and they open entities abroad where they're tax-free countries, they open their entities there and then they do business from there and don't pay tax here. So they don't pay tax here, they don't pay tax in those countries also, and therefore they would go tax free. So to tax this kind of transactions, these sections have been brought in. Now, for example, Google, you see a lot of ads on Google. Now, when you give ads on Google, the ads relate to products of India, but Google is based in US. The ads are in US. The income benefit that you get on business would be in India, but ultimately you are advertising abroad and Google is earning abroad. So there is no tax paid on those. So this kind of transactions, when you enter into, then the tax department has brought in this tax sections, the government has brought in these sections to bring in this kind of transactions and transfer pricing transactions. Suppose there is a company like some international company which has a base in India, which has a company in India as well as a company abroad. And there, the company abroad then sells certain uh, products to the Indian company. Then there is a question whether they are fairly charging the price, or are they just giving it at some discount or not charging anything. So in this kind of foreign transaction where it is found that the charging is not based on the fair market value of fair pricing, then there would be tax. Therefore, they have brought in these provisions that whenever there is this kind of foreign transaction, then you must, what they call, is deal at arm's length. They have defined arm's length, that it should be a clean transaction where the price should be a price which otherwise you would also be paying for that product to some third party if not related to you. So these companies are related, and if they are not related and you are paying to the market price there, then the same price you should pay even to your related company. And therefore there is uh, this situation arising where they have therefore provided that you must have a transfer pricing done in a particular manner. There are 6 modes given in which you calculate your transfer price and inform the government. You give certificate of chartered accountant and say, okay, look, this price is a fair price, and this transaction which we are dealing with, the foreign transaction which we are dealing, is at arm's length and therefore clear, and therefore no tax is involved. But if this is not there, then the government will levy tax, saying that you are trying to avoid payment of tax. There is one new also chapter in part of chapter 10, which is General Anti-Avoidance Rule, GAR, which has been brought in. These are new provisions, therefore you may go through them. It may be asked, it may not be asked, but since they are part of the syllabus, you go through them. Then there is, now we are coming to how the income tax is assessed. So there is all procedural chapters which relate to return of income, how the return of income is to be filed, by whom it is to be filed, and then it goes to how the assessments are carried forward. There is regular assessment, then there is best judgment assessment. All these are also coming as short notes. Then there is search and seizure proceedings under 132. There are appeal provisions, revision provisions which you have to deal with. Because of shortage of time, I cannot go through in detail in all this, but these are all these sections which you have to go through. A lot of short notes are asked, a lot of questions are asked on this basis. These are all procedural parts. Who are the IT authorities who are dealing with this? Section 154 is important, rectification of mistakes. That you should know when and in what circumstances mistakes can be rectified by the assessing officer. Then there are provisions of payment of advance tax, provisions for payment of TDS. These also you will find in Master Guide and in the Ready Reckoner, the list how and when TDS to be deducted, at what rate TDS to be deducted. You will all must have noticed that in this COVID-19, the finance minister has announced that at present the TDS rates would be reduced by 25% to give relief to everyone. So suppose on professional charges, you have to deduct 10% TDS, instead of 10%, you have to deduct 7.5%. Then TDS is also to be deducted when there is a sale transaction in India. Then on Indian, any person who is a purchaser has to deduct 1% TDS from the consideration amount. Now instead of 1%, he has to deduct 0.75%. Similarly, in case of foreign, suppose there is a non-resident who is selling a property, then TDS has to be deducted at the full rate of capital gains which would be charged to him, unless he gets a certificate, which I will come to, which is under 281. So that 281 certificate is a certificate where under section 281 you have to apply to the assessing officer under which you fall, under which you are assessed by him, where you apply that, look, I will not be taxed, or I have made sufficient provisions for payment of tax, and therefore my tax not be deducted or be deducted as a lesser portion. So 281 section provides that no transfer should take place unless a provision for tax has been made, otherwise that transaction would be void. So when a sale transaction takes place, solicitors will insist that on the seller to get a 281 certificate to ensure that, look, there is no tax provision. So tomorrow that transaction cannot be avoided. The tax authorities cannot say that this was a transaction to avoid tax and therefore this transaction is to be set aside. So therefore you must understand this section and how it applies to our transactions, sale transaction. It is very important. Particularly when non-resident persons are selling or companies are selling, then this section becomes very important, that you should know that the seller doesn't have to pay any tax, or he has made sufficient provision for payment of tax or for reinvesting in some another asset or whatever, take benefit of tax, and therefore he would not be liable to payment of any tax. Then comes uh, what I was mentioning earlier in the definitions, chapter 16, which are special provisions applicable to firms. So in case of partnership firms or LLP, there are some special provisions provided in this act and you must go through them. We are short of time. We have already had more than 1 hour, almost reaching 2 hours. So I will conclude here. We have not kept any question answer session because, as I told you, question answers would mean another 1 hour session and also dealing with all your problems. We are proposing to have, if time permits, separate sessions for question answers on all these topics, so that we can actually sort of uh, sit with the past papers and solve those problems for you where you find difficulties and help you there. But let's see how it goes. I hope you have enjoyed this session and you'll continue. This is just a view, this is just with a view to explain and give a brief background of what is there. As I mentioned, this is only a 50-mark paper. A lot of things are included in this, but you can go through the past papers and see what is commonly asked, and you can study that more so that you can easily answer them.
Nilesh,
Ah,
can you just say when is the next seminar, a
yes,
webinar, and
yes,
what will be the topic if you have it?
yes, yes. So next, I will be announcing that every time, or maybe somebody will be announcing. Next session is on next Wednesday, again at 4:30, and it is on CPC, the portion of the first portion of CPC, which will be up to certain sections of CPC, says up to section, no, up to order 20, I think. The first portion of CPC up to order 20. There are two persons speaking on CPC. The first person speaking is Dhruti Kapadia, and the second person speaking is Rajmani Verma. Both are solicitors practicing litigation. They are very well versed with CPC. So one is going to do a part of CPC, the other is going to do another part of CPC. One will do on Wednesday 4:30, the other will do on next Saturday 4:30. And a third session on CPC will be done later, which will be only on Order 21 execution, for which I am inviting, most likely I'm still speaking to him here. He's going to tell me the date and confirm it, but he is an advocate specializing in execution, Mr. Gaurang Mehta. So he's specializing in execution. So I'm going to have a separate session on Order 21. I'm getting some messages. Thank you for your messages that you are finding it. I hope it was interesting and not boring. Anyway, thank you so much. So keep continuing, because a lot of other solicitors are on the way. Once we finish CPC, we'll have sessions on SEBI regulations. We'll have sessions on company rules and regulations. We will have senior solicitors coming for that. We have senior solicitor coming for conveyancing and transfer of property. And we have 3-4 sessions on conveyancing paper. We have 3-4 sessions on company law. And we have different sessions for topics on in the general acts and in the in the commercial law paper also. On different topics, we have different sessions. It's not just one paper, so everything is covered in one session. So everything is going. We are also having some counsels who are coming, who are solicitors and who are coming to speak on certain acts. So do stay in touch. Thank you so much.
Thank you, everyone. Thank you, Nilesh.
Thanks.